everyone. I'm Priyanka Dhingra. I'm an ESG analyst with SBI Mutual Funds. Let's talk about ESG investing today. It's a very highly evolving and very interesting space to talk about. There are so many confusions about the space of ESG investing. There are so many different types of terminology that we generally come across in the newspapers, in the various forums that we attend. Some people call it sustainable investing, some people call it responsible investing, ethical investing, SRI-based investing. But all of these terms have some similarities. There are very minute differences between all of these strategies. But all in all, ESG investing is a strategy where you intend to increase long-term returns alongside creating positive value for environment and society. So that's ESG investing for you, and you can name it in whatever way based on the different strategies that you follow for investing. Now, people generally ask us, what are the various kinds of strategies of ESG investing? So let's talk about some of the more famous ones that people know about, and they are more commonly adhered to in the global scenario, also in India. The first one being an exclusionary strategy or negative screening. This is pretty simple. So you believe in some sectors and you don't believe in certain sectors. You feel that there could be some sectors which have a negative environmental or social connotation, or your faith does not allow you to invest in certain sectors. You simply exclude them from your investment strategy. That is exclusionary strategy for you. Over and above that, there could be investors who are excluding companies which are involved in let's say high controversies, or they want to keep out of their portfolio companies that have very low ESG scores. Even that could form part of your exclusionary strategy. It is one of the strategies which is quite predominant in India and specifically in Europe. The next strategy, which is very famous and also quite upcoming, is the integration strategy or best-in-class strategy. In the integration strategy, you are not typically removing any sector from your universe of investments, but you are typically looking at which are the stocks which have been rated by third-party providers and which of them are best among the lot. ESG ratings are a good tool to understand the ESG performance of a company, but they are not the only tool. So you could see that ESG engagements could also inform your investment decisions. The idea of integration is, on top of your financial assessment of a company, you also assess them for their historical ESG performance as well as their future direction that they want to take for strategies and targets on ESG. The third upcoming strategy is called impact investing. And as the name suggests, it aims at creating a certain impact on the matrices of environment or society. So imagine, for instance, I want to start a new fund, but I have a certain impact in mind. I want to help in water conservation, for example. I can create a fund which may be an impact fund only for water conservation. So the universe of investments will only consist of stocks which are either developing products or services for water conservation. This will then be quantified at the end, just to understand how much impact has been created positively for the objective of the fund. The next category is sustainability-oriented funds. Now, they are more broader, but they are similar in impact like impact funds. So you will take up a sustainability objective. So for example, there are 17 sustainable development goals, and let me hypothetically pick up SDG 13, which is, let's say, climate action. Now, any company which is positively contributing towards climate mitigation or adaptation or resilience could ideally form part of this investment strategy, which would mean that I can look at companies which have products and services catering to this sector, or companies themselves are reducing their carbon footprint. Any of these companies could form part of my portfolio or investment universe, and ultimately they should be contributing towards climate action. So these are the kind of popular strategies only in equity, and there is then this entire universe of green, sustainable and social bonds, which is called the GSS category in the debt side. Now, this is also becoming very popular, more so after the announcement of sovereign green bonds by India. And this category is very similar in design to any normal bond that you really look at. However, there are two minute differences, and they are very important when we are looking at GSS bonds. The first one is that the use of proceeds is very clearly laid out. So the use of proceeds has to be for an environmental, social or sustainability related area. Banks can raise these bonds, investors can raise these bonds, corporations can raise these bonds, and even sovereign green bonds, as we were talking about. Sub-sovereign sovereign entities like municipal corporations can also raise these green bonds, but the end use of proceeds needs to be for some environmental, social, or sustainable purpose. The other most important thing about such bonds is regular monitoring and reporting that you have sort of achieved, or where are you in the journey of achieving the outcome that you have sort of set out to achieve in this particular bond. So these are some of the popular strategies that are used for ESG investing. But one of the questions that keeps coming back to us is, do we really have to sacrifice or compromise on profits when we are investing for the greater good of environment and society? Now, this is a question which we need to answer, but before I attempt even to answer this question, let us get something straight. ESG investing or sustainable investing is no more a choice. It is a definite strategy that we all as investors have to integrate. Imagine a scenario where in a country like India, 38% of the population is millennials. Now, these millennials are very, very woke. They want to ask us questions of how their money is being used. They want to, use their money for investments only in companies which are not creating anything negative for the society or environment. They are climate conscious. They are diversity conscious. And all the investment managers have to answer to these largest pool of future investors which will be investing in our funds. So it's our fiduciary responsibility to create long-term value for them and to invest their money in companies that we actually believe in. And that is where it sort of establishes itself as a strategy which is no longer chosen for a particular product but becomes a part and parcel of our everyday working. Now we come to addressing the point of whether we are foregoing profits or foregoing any kind of returns when we look at ESG investing strategies. Now, there are two parts to this problem. One is, does ESG help you mitigate the downside or protect the downside in turbulent times? This part is easily addressable because there are so many studies that have been done which establish this already. Downside protection ESG does give you, because imagine not being an ESG investor and still picking stocks. What kind of companies would you pick? Which are having sound management, good governance, which are governed by ethical people, clean books, not too much regulatory history of fines or controversies. Exactly, this is what we are doing in ESG investing. It's just that ESG concerns are proactively looked at and not reactionary in approach. So all of these companies tend to perform better returns-wise also and protecting your downside also during turbulent times. And one of the greatest example is the COVID time. During COVID, even SBI Mutual Fund had a study where we looked at top ESG performers versus bottom ESG performers, and we found clear outperformance in terms of ESG leaders in the rating frameworks. Now, so this is established. Now comes the second part of the problem. Does ESG create opportunities? Does it beat benchmark? Does it outperform its traditional peers? So for that, there are multiple studies that have been done. What I have done for this interaction is to look at 3 different studies from 2020, 2021 and 2022. The first one being Morgan Stanley Institute for Sustainable Investing. Now this is a 2020 study where US sustainable equity funds were peer benchmarked according to their other traditional peers, and we found outperformance by a median total return of 4.3 percentage points. US sustainable bond funds also outperformed their traditional peers by a median total of 0.9 percentage points. US sustainable equity funds' median downside deviation was also 3.1 percentage points lesser than the traditional peer funds. And if you look at US sustainable taxable bond funds' median downside deviation, it was 0.4 percentage points less than traditional peer funds. So in 2020, before we were entering the COVID stage, we see clear outperformance of the ESG-based funds in the US market. Let me point you to another interesting study by S&P in 2021, which used the S&P Global Market Intelligence data. It monitored the price change for 27 ESG exchange-traded funds, which were tracked, and mutual funds, and the asset under management was around USD 250 million. Now, the data was basically looked at from December 2020 to May 2021, and 16 out of these 27 funds performed better than the S&P 500. And those outperformers rose between 11% to 29.3% over that period, and in comparison, the S&P 500 only increased by 10.8%. So this established in 2021 that there is a clear outperformance. And let me come back to 2022. Now, 2022 has been characterized as a period when globally, the markets have not really done that well. In that scenario, we have seen a lot of loss of value in ESG funds also. But let me also, sort of point to the right direction here. There were political headwinds, because of the Russia-Ukraine war. Defense stocks moved up. Oil stocks moved up, commodities moved up. ESG funds specifically, which are following exclusionary strategy and otherwise also, generally tend to stay clear of such stocks, because of which ESG funds may not have been able to beat the benchmarks or done exactly very well as compared to their traditional peers. But then again, I'm pointing to this Bloomberg study from 2022. In 3 broad categories, Europe-focused, US-focused, and global ESG equity funds, Bloomberg found that they have done better this year on average than their non-ESG counterparts. All are negative, and that's in line with the broad market sell-off, but ESG funds are down lesser than the others, in spite of the typically tech-heavy, energy-light portfolios. So this kind of establishes that ESG funds have done better even when you compare them to their traditional benchmarks, and these are recent years' data that I'm pointing you out to. When it comes to alpha generation, we should also look at ESG opportunities. Now, if you look at the various commitments the various governments are doing with respect to climate or with respect to sustainability, sustainable development goals, you find that more and more opportunities are getting created. Consider electric vehicles, for example, or green hydrogen, for example, or many opportunities in carbon capture and utilization, renewable energy. All of these are green industries which will see a lot of new investments coming in. And if new investments are going in, of course, they'll bear the green tag. So there's a lot of opportunity of alpha generation there also. So to answer this complicated question, ESG related stocks or ESG funds do have a potential to generate alpha. They have a potential to protect the downside and outperform the peers. However, in India, if you look at the data is not too wide. So we started, one of the oldest funds was started in 2018. So there's only 4 years worth of data. So which is why it will take time for the data to evolve and to put things into perspective. But let's talk about what is the total market size of ESG related investments. So total global AUM tied to ESG frameworks or indices that we can look at surpassed USD 35 trillion in 2020 already. And we are poised to reach USD 41 trillion by the end of this year. And there are estimates from Bloomberg that we'll reach USD 50 trillion by 2025. The money held in ESG-focused ETFs rose globally to USD 0.75 trillion in the first half of 2022 itself, and it is expected to cross USD 1.3 trillion by 2025. If you look at the debt market in ESG, we are currently at USD 4 trillion, and we could swell this up to USD 15 trillion by 2025. Now, Europe accounts for half of, or maybe more than half of global ESG assets. US is now expanding, and we have seen that they have dominated the category in 2022. But the next wave of growth could come from Asia and particularly Japan. This was the global trend, but in India, things have been looking very positive too. From 2018 to 2021, the number of ESG funds have grown from 2 to 10. And the AUM has risen from INR 3,400 crores to INR 10,000 crores. But there was a peak in 2020-2021 where it crossed INR 12,500 crores too. So we are lower at AUM but growing, and we are on the right path. If you look at the GSS debt issuance, GSS being green, social as well as sustainable bond market, the increase has been more than 6-fold, and we have reached USD 7.5 billion in 2021 following a pandemic-induced decline in 2020. The cumulative volume, which is very important here, has almost doubled in the last 2 years to represent 19.5 billion USD in value. So if you look at that statistic, we are currently 19th largest GSS market globally and 6th in the APAC region, just behind China, Japan, South Korea, Australia, and maybe Singapore. Now, there are many things that India wants to do. India plans to issue 160 billion rupees, which is equivalent of USD 2 billion of sovereign green bonds in the fiscal year ending March because of renewable energy targets and various other targets that the country has taken. And it is not only this. The ecosystem in itself is developing around facilitation of green finance. For instance, SEBI has mandated top 1,000 listed companies by market cap to report mandatorily on BRSR framework from FY23. BRSR means Business Responsibility and Sustainability Reporting. Stewardship Code has been made mandatory for all insurance, pension funds and mutual funds by the respective regulators from FY18 to 20. RBI, the Central Bank of India, has signed up to NGFS. NGFS stands for Network for Central Bank for Greening the Financial System, and has also come out with a consultation paper which says that all the banks in India will have to look at task force of climate-related financial disclosures based disclosures on climate. That's on the risk mitigation side. Not only that, Ministry of Finance has set up a specific task force to work on Indian taxonomy. SEBI has already made a lot of changes in how the ESG funds disclose their assets and the portfolios to their consumers. And in 2022, there were various other regulations that came in specifically to highlight how ESG is being incorporated in these ESG schemes. India has also taken up very high targets on decarbonization. For example, India has said that our entire, we will be a net zero economy by 2070. We have aggressive decarbonization strategy up to 2030 that we will have more than 50% of all of our energy coming from non-fossil sources. We will also reach 500 gigawatt of non-fossil energy capacity by 2030. Now, all of this needs a lot of finance, and all of this is going to come from green finance. Combine it with the efforts that we have on the side of sustainability and social finance, and all of this will turn to be a huge chunk of green finance. Millennials are asking for it. Investors are spending money in it. Government is making rules to ease the entire process. And I think which is why we see that ESG investing will no longer be a standalone strategy applied in only a few funds. It will be a strategy which will be applicable everywhere. And that's where the role of each of us as consumers and investors comes. So finally, as the largest asset management company in the country, SBI Funds Management has also taken up its role in advancing the ESG strategy in its investment practices. We have the largest Indian ESG-based mutual fund, and on the PMS side also, we have an ESG-based category fund. So we are doing our best to advance this strategy in the country. Hope you will also be able to contribute to this. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.